Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm once again joined with my good friend Doug. Hey, Doug.
Hey, Kirk. I think they're going to start calling this the Kirk and Doug Show.
Yeah, I think we're going to have to the Kirk and Doug segment. It's
Right.
yeah. I mean, we're getting a lot of great feedback from this, and please send your feedback. Love us or hate us, we just want to hear from you. So we actually got some pretty good promos coming out, which I think you'll all enjoy. If you appreciate our perspective on inflation, I know you're going to enjoy them. So let's dive right in. So Doug, what's new this week? What should we talk about in this in this world where every day is topsy turvy? I feel like it's the twilight zone where up is down and left is right. So what's going on in the world?
Well, let's see. Let me get my bearings back straight here. Okay, which direction am I headed here? Actually, you know what? When relating that to charts, up, down, left, right, whatever. I think two of the things that we've talked about and been kind of seeing lately that are really hitting people directly, of course, is inflation. And I think there's a lot of concerns going on with housing. And I think those, let's talk about a few of those points today, because I'm sure that that's on the back of everybody's minds.
Okay, well, let's start with housing. I just had a client of mine send me a news clip which says Bank of America just launched a zero down payment mortgage in 21 cities that could make it cheaper and easier to buy a home. Now, granted, this news story didn't have a lot of detail to it, but basically, anytime I see a mortgage company is going to launch a zero down payment mortgage, that's probably a bad sign. I don't know if if you were around long enough to remember 2008, pretty much from 2003 to 2008, that was not a good period for banks if they were launching 0% down payment. So I don't see that as a good sign. I think it's a sign of maybe trying to extend and pretend like we did a good job back then of let's just like push things off in the future and hopefully they never become a problem. But zero down payment, that I don't see how that's going to end well. What are your thoughts, Doug?
Well, I'm going to give an unpopular opinion on this, and I think it's fantastic, but I think it's fantastic for all of the wrong reasons that people will get them. Okay. I know why Bank of America is doing this. Things have gotten expensive. It's hard to come up with that initial 20% down payment. And so now you could fully finance whatever you want. I mean, there's still limitations based on income and economy. Listen, the unpopular opinion here is, listen, the numbers there, the math and the science, the best mortgage you could possibly have is going to be one for the longest duration that you have for the most amount you can get. But this is a loaded point because I know everybody's like, what is he? This guy's crazy. They're shutting us off. I'm being canceled right at this moment, Kirk. I know that. But here's the reality of that. That is all under the assumption that you're making good housing and financial choices in the first place, right? When you are trying to get a loan or trying to even get housing, and not a housing never stops as a cost. When you are trying to get housing, okay, there's a couple things that you need to think about first with that. Is first of all, it's not what the bank says you can afford, it's what can you afford. And then you have to really put into the equation all of the different things that you've got that you need to take care of in after cash net flow and also savings. Listen, if you're out there, and I know this is going to be really hard for a lot of people to swallow, and you are you're not putting as much away in savings and as much away for your future as you're paying every month for housing, something's wrong. Okay. And what's going to happen with these Bank of America loans is that's exactly what's going to continue to occur. Housing prices got driven up by low interest rates and lots of accessible money, which has been pulled back. And now Bank of America is trying to find a way to get the last remaining few into buying housing that is more than they can afford. As a general concept of financial planning, though, if you are being able to put together a plan and think about the way things should be structured with it, I love the concept. If it, me and you've got the plan in place, give me all the money I can, because remember this, when you put your money into a house, you're creating a qualified plan. The money there, you got to qualify to get back out. Okay, it's locked at the bank, and you earn zero rate of return on a down payment, zero rate of return on any equity in your house, because your home, and I know this is probably something not everybody knows, but your home's going to appreciate whether or not you have it fully financed or not. They're completely unrelated. So every extra dollar you give back to the bank, you lose the power for that money to ever earn anything. So that's why you got to go into the planning by putting your money in a side account, saving it elsewhere. And that goes back to those rules of thumb. So again, if you can get money with no down payment, I love it. Okay, you're still going to pay PMI. But for most people, and unfortunately, I know what's going to happen here, most people that they give these loans to, it's going to be a lot more than they truly can afford. It's going to be what they qualify for. And I can see a lot of problems in summary coming out of this.
Well, I'm going to give a response to that, which is an unpopular opinion to your unpopular opinion, is actually a little bit more context to this, which is this loan program, the Community Affordable Loan Solution, is based on providing mortgages to Black and Hispanic communities. And so, which is fine. I think, if they're trying to increase homeownership, personally, I don't like those kind of programs, not because of what they're trying to do, but because of what we call the unintended consequences, which is how economics work, right? Oh, I want to help out people that may have been disenfranchised, or just, help groups that you just want to help out. Totally with you. Totally supportive of that. It's always the how you do it that's the problem, right? So this might be one solution. So here are some problems. Okay, so we went from a 2% 30-year mortgage, now it's up to 5.5%. So the payments have gone up a lot. Also, what happens if real estate prices drop a lot? So you start with no down payment, which means you have no equity. Actually, you have negative equity, because what this program is stating is you don't have to pay closing costs. You don't have to pay anything. You literally just, you sign up and you can walk in and you start your payments, which means that all of those other fees that everyone else pays to get into a house, all of that is backed into your mortgage. So technically you probably have a negative equity in your home. So, which, if you're going to hold it for the next 50 years, is probably okay, because over time real estate does tend to go up. But what happens in the next 5 years? What happens if the real estate market drops 40%? I mean, we talked about in the show, if real estate prices go from 2 up to 7.5, that could be a 50% drop in prices due to affordability. Now, it may not be 50, but what if it goes more? What if we go from 7.5 up to like 12% mortgages? Then what's your real estate price is going to be? My point is, you could start, this program could get you a $100,000 house, which in 5 years could end up being a $30,000 or $40,000 house. But yet you're still making payments. Then what's going to happen? Then you have all these people who are going to say, here are my keys back. Why am I paying this? I owe you guys 70 grand when I took out 100, and I have, on top of that, I still owe you money because I have no equity, and I can't sell my house because I have no equity. So all of these problems are caused because of these unintended consequences. And like I said, the intentions are sound. I don't think anybody disagrees that with the intentions. I think it's how you go about the intentions that's the problem. And quite frankly, if you want to talk about political division in this country, if you really think about it, the left and the right, we want the exact same things. We just disagree on how to go about it, right? We disagree on the solution. The problem is the same. We agree on the goal. We don't, people can call each other names all they want, but in reality, if you break it down to brass tacks, we all agree to the same thing. We just don't agree how to do it. And, when you look at this is an example of something that happened in the early 2000s, early to mid to even late 2000s, where you're allowed to get ninja loans, you're allowed to get 0% down payments, and it just leads to problems, because if I bought a house and it's literally cut in half in price, I'm just going to give the keys back. Like, why am I going to bother? Like, why am I going to bother paying something that's not worth it? Now, if I'm going to own it for 30, 40 years, that's fine. But, there are consequences for decisions, right? If you're going to give something, then you need to get something in return. It's a balance, right? You can't just say, oh, we're going to give everything to people for free. Yeah, you can give people free stuff, but then it takes from other people to pay for that free stuff. There is no free lunch, right? If you're putting it somewhere, you're taking it from somewhere else. That's just like a framework you can think about for life, definitely in finance. So while I think the idea is sound, I think the way they're going about this is going to end up causing more problems. Because then the other thing is, what if hypothetically, rates go down, right? And real estate prices haven't dropped, and you want to refinance. is this institution or other institutions, I don't mean to pick on B of A because I think other ones will follow along, are they going to allow you to refinance? Right? If rates are 5.5% and they go down to 2, are they going to allow you to refinance? You're going to be stuck at 5.5 when everybody else is paying 2. So these are just questions that come up for me about this. And I'm sure they're not educating people fully about the different nuances of this because that's not their job. Their job is to sell mortgages. So while I think it's a good thing in terms of, what it gives people more access, it also comes back to this conversation that we've had a lot in the show is, why do you need to own a home? Right? Why not rent? I mean, the financials for a lot of homes actually favor renting. So not against home ownership. I'm very for it, but people should never neglect renting as an option. Renting is always an option. It can be a very good option for many reasons. And you shouldn't just discount renting just because, hey, it feels good to own a home. Yeah, it feels good to send your kid to college too. But when you owe $500,000 in college debt that you can't repay, well, did it feel good? Maybe for a moment. Does it feel good now? Probably not. Right. So there's always consequences for actions. So you can't just say, oh, it's great, let's put people into a home. Yeah, but what's the other side of that? So I just want to bring that up because I think it's while it's a good idea, the unintended consequences or the consequences that certainly weren't laid out in this article, could be quite substantial if enough people buy into this. So what else? Let's kind of get into another area here, Doug. We missed a lot of stuff from last time. Since we touched on college, this is a good a weird segue to get into college. I know this is your area of expertise, but I wanted to point out this chart here I found. It was pretty interesting. And it talks about the 20 largest college endowments. They're probably names right? There's Harvard, there's Yale, there's Stanford, there's Princeton, there's MIT, UPenn, Notre Dame. I mean, you can go down the list. All the names. And these schools are the largest college endowments in the country. So I want to point this out, and I'm going to let Doug riff on this because he knows a lot more about college than I do. I've got a lot of opinions, but I'm going to let Doug take it. So what are your thoughts, Doug?
Well, when you look at this list, Kirk, here's the funny thing that you see in all of these. When you start looking at Harvard, University of Texas system, Yale, Stanford, Princeton, etc. Interesting that the schools on this list, the ones that are considered to be the most prestigious in many ways. And by the way, for those that are listening, you may not know this, but the word prestige actually comes from the Latin root word to mean deceive. So there, just to kind of put some correlation there between what prestigious is, they are deceiving you in many ways for the value of your investment. And if most of these schools here are many of the most expensive schools to go to in the United States and many of the hardest schools to get into in the United States. Now, ironically, many of these schools can also be the most generous schools for those that have extreme financial need, the lowest ability to pay for school. They will tout that they have 100% need-based aid for those that deserve it. But here's the reality. It has gotten harder and harder to qualify for need-based aid. And even if they write that off, these days, the amount that they still expect you to come out of pocket could be $10, $20, $30,000. And for most people, you're not going to qualify for need-based aid. And these schools, hands down, top to bottom, are some of the stingiest schools in the entire country. If you do not qualify for financial need base, they have enough people willing to write whatever check that they want to write just to have that bumper sticker on their car, regardless of the outcome, and pay full price. And they will absolutely expect it. If you were to look up Princeton, there is no merit aid offer. They don't even list an amount because it's non-existent. So these schools are absolutely raking in money, charging extraordinary tuition, cost of attendance in the $60,000, $70,000, $80,000 plus range, and ultimately expecting almost everybody who's entering into those systems, if you can get in and you are financially can't afford it, you have won the absolute academic lottery. But for 99.9% of people that try to go to any of these schools, you are going to pay absolutely outrageous pricing. The return on that investment, I'll give you an example. So two schools that I look at, New Jersey Institute of Technology and Drexel. Drexel's a very expensive private school, New Jersey Institute of Technology. Here is a school that if you were out of state, you might pay $35,000. At Drexel, you might pay $70,000, $75,000. Big difference in cost. If you're in state New Jersey, you're not going to pay near what I mentioned here, but let's just get the pricing a little bit more on par. $35,000 for New Jersey Institute of Technology, $70,000 for Drexel. Guess what the starting income of the same engineers coming out of both of those schools ends up being? About $200 difference. So ask yourself, if you're going to pay $35,000 a year or $50,000 a year more for the exact same result, is that good money spent? And the reality is, it goes back to prestige. These are schools that charge an extraordinary amount of money because they have an absolute branding. They play the game is set up against you, and they're getting all these donations. They're rich as can be. They have all this money, and then they sit there and continue to jack up prices to get people to pay full price. And ultimately, we wonder why there's a debt problem for student aid.
Well, I'll tell you, Doug, I've got some strong opinions in this. And quite frankly, I was talking to some people many, many years ago, and I had this idea, which I'm not sure it'll fly because there's just too much special interest in this country. But I would say if you have an endowment or a nonprofit that has over a certain amount of money, you should be paying taxes. And I don't know what that amount is. Maybe it's 10 million, maybe it's 20 million. But over that, you should be paying taxes. You should not be tax exempt, because there is no reason, and I don't mean to pick on Harvard, but they're first on the list. There's no reason Harvard should have a $51 billion endowment and not be paying taxes. They and MIT own like more than half of Cambridge. They actually have to pay taxes to the city of Cambridge, because if they didn't, they wouldn't get any taxes. So, it's stuff like this that just warps the economy. And not against schools, right? I think they have their merit, certainly, and they have a lot of value. But I mean, let's be frank, you don't need $51 billion. What are you going to do with that? You're going to buy a country? Like that's just, they were the second largest nonprofit in the world, behind the Roman Catholic Church. I think they had the largest amount of money in nonprofit in the world, and Harvard was second. So that should say something. You're talking about institutions that, if you want to go charge the rich higher taxes, start charging these endowments. They don't need that money. They're just using the money to build more money. And I'm all for that, right? I'm all for, but what are they actually doing with it? Are they doing anything that benefits society beyond their own circles? I don't know, but it's a question to ask. And I think the fact that they're not paying taxes is just a travesty, but no one's talking about it. No one's saying, oh, well, these people should be paying taxes. And there are plenty of nonprofits that are smaller, and they should not be, because they need the money, frankly. I work with some of them, and, let's say you got $10 million in endowment. If you start taxing that, some of these institutions would fold. Like they're not self-supporting. But if you have $52 billion in endowment, I'm pretty sure you're going to be okay. So I really don't think too highly of that structure. I think that, they should be giving back more than they do. Frankly, they should be giving away free education if they have $52 billion, right? They shouldn't be charging students at all. And then they can take in whoever they want. But like you said, Doug, they have the branding, they can get away with it. I totally understand that. It's a free market economy. You can do what you can get away with. I just think that if you're not paying taxes, it's not really a free market. So, this is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone, and the prizes stink. But here's what you're going to win: higher prices at the store, shrinkflation in your packaged goods, higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. But, let's move on here. So you sent me a wonderful chart here, Doug, last week, which I'll point out here, which is showing the 60s and the 70s, my favorite period, which you talk about a lot in the show, late 60s into the actually early 80s. Basically what it's showing is inflation leads to higher unemployment. Now, obviously, this is a correlation, not a causation, but I would say, there's a high correlation here, which you could allude to, saying high inflation should lead to higher unemployment. So if you look at this actually ties in multiple concepts that we've been talking about here in the last few months. One of the concepts is inflation is going to go higher, right? So you look at the 70s, that was a period where inflation kept going higher, but it also combines the bullwhip effect, which is inflation went up, then it went down, then it went a lot higher, then it went down, then it went even higher, and then it went down. So the point is, and you can look at lumber prices. We showed a chart of lumber on the show many weeks ago, and look, lumber's done the same thing. It went up, then it went down, it went even higher, it went down, then it went even higher, and it's the bullwhip effect. It's just how it works. You can know this is happening, and it's still going to happen because you can't predict the future movements of consumers. The best you can predict is it's going to look similar to this. And we don't know that for sure, but if I was a betting man, I would say it's probably going to look something like this. So the point is you have inflation, and the cool thing about the chart is it actually points out the difference between when inflation picks up and when unemployment picks up. So if I look at this chart, you're looking at between 1 and 2.5 years. So as an example, inflation picked up last year. I think it was around mid-year. I have to go back and look exactly. But right around mid-year, inflation started to pick up, and it was a lot higher than normal. And people said, oh, it's just used car prices. It'll go down. And then, of course, it didn't. It went to, 9% plus in inflation. But it's come down a little bit. And I suspect it'll probably come down a little bit more. I think it's, from just being a consumer in the economy, yes, things are going higher, but I don't know that they're continuing to go higher. I think they've gone higher and they're going to stay. Although, we have had some increase. The place where I get my haircut just apologized that they had to raise their prices from $20 to $30 for a haircut. They felt really bad about it. They're like, all my other prices are up. I can't help it. And she was like, I really apologize. I don't want to do this. I even drive into the city now to get my haircut, and she's great, and I'll still go to her. But, that's the point, is like, these people are passing it along because they have to, not because they want to. So anyway, this gets back to the first wave was about 2 years, 2.2 years. So you're looking at maybe another year. So you're looking about mid next year where unemployment starts to really pick up. And then, the next peak and trough for about a year. And then the last one was about 2.5. So, I don't know if it'll follow the same thing. We talk about this a lot in the show. It may not mirror it, but it'll probably be pretty similar. And I think the similarity is what you should be thinking about, is not that, oh my God, it's going to take 2.2 years. Rather, hey, this is really interesting. Let me introduce this into my mental framework of how I'm thinking about the economy. And if I think that things are going to take off, maybe I should kind of re-gauge my thinking and say, well, it might, but then it's going to come back around with the bullwhip effect. So what are your thoughts on this chart, Doug?
Well, my first thought on this is that this really ties to, just economics 101, right? So when we see inflation, we always think of it as a consumer and something that we are now paying out of pocket and having to cut into our budget, right? But the reality is that those prices are being passed on to us. They are pricing that is started at the business level. And so it means that all of the materials that they need to produce whatever they are producing are costing more as well. And so what, a lot of times they say, well, hey, they're just jacking their prices, they're just making more profits. And let's face it, there is a reality there. When you see prices go up, you start to see profits go up. I mean, very few companies are going to sit there and go, ooh, our cost went up by $1. Let's just raise it $1. Somehow that just sneaks in a little extra 25 cents there. But the reality is these companies are struggling to cover the costs of their goods sold. And if you do that and you start to see your bottom line become affected, what is the first place that companies often look to fix a cost problem? And that is, let's raise productivity within our organization. And by the way, there's a natural correlation between productivity increase and headcount decrease. Imagine that. If you have half the people and the same amount of work, those people end up doing twice the work, right? And companies will expect more out of the people that work for them when their prices go up, and they will cut those costs. And so I think that when a company starts to see that is a sustainable cost problem, and again, the way the stock market works is a little bit different these days than say back in the 60s and 70s. I mean, like everything with our cell phones, we are just impatient about everything anymore. Back in the day, corporations made a little bit more decision about maybe long-term thinking for companies. We know you would agree to this, Kirk, this day and age, it's all about what does Wall Street want. 90% of the stocks out there are owned by institutions. They're owned by funds and other types of investment managers, and they demand accountability from those organizations. So guess what happens? All of a sudden, Wall Street's beating on them. Your costs are up. Where's the profit? Where's the profit? Management goes and is like, you know what? Quickest way to get that profit back up, cut the bottom line, cut people, cut those jobs. And so when they start to see those costs creeping up, and this may be happening faster than it ever did, the first place that they are probably going to end up turning is headcount.
Yeah, and that actually brings up an interesting point, because we have a chart here I'm going to bring up. It's called the Hope Chart. And we might talk about this more next week, because I did want to talk about one more topic before we wrap up. But this Hope Chart, it really just talks about the progression of, if you're changing for how the economy responds to a change in rates. So the first one to hit is housing. So housing slows first, then new orders, then profits, then employment. So employment tends to react last and is the most lagging part of the economy. So I'll put this chart in the notes. We'll talk about it more next week. But I think it's a good framework to think about, because, we all think, oh my God, the economy is going to crash. Well, no, higher interest rates definitely has a negative effect. And the market definitely is looking at it negatively, because the market's been down a lot this year. And even though it's bouncing around in expectation of what the future rates are, which we talked about last week. But if you think about it, housing's first. Housing moves slowly. So that's a really important concept, is housing moves really slowly, because it's been what? Inflation was last year, I think, is when it started to rise, about a year ago. And housing, even though the stocks went down, housing's just now starting to drop a little bit. And that's over a year, right? So it's taken a year. So and they're the first, right? And the stock market went down first, because that's future expectations, which is, 6 to 12 months. But next is new orders, right? So people order fewer things because they can't afford to. We just talked about my I guess it's a hair salon. It's not a hair salon, but it's not a barber anyway. So it's a combination of the two. I'll call her a barber. But basically there's impacts to up and down the supply chain, right? Because, hey, we can't order as much because we need to put more money up for other things. So this disruption just causes the new order flow to stop. It goes up and down the chain. And then, of course, the profits are next, because right now, what's been interesting is up front in the inflation cycle, like up at the front end of the curve, when it first starts, a lot of these companies start raising their prices. And they get away with it. And what they're also doing is they're raising their profits. So if the prices are going up 20%, their costs probably went up 10, and they added 10 into their profit margin. So it's not necessarily those numbers, but that's what I mean. So what happens is a lot of companies, and I've noticed this in the last year, is when they're raising their prices, they're also raising their profits because they're able to, because prices are moving so much. How do you gauge one price versus the other? Oh, I'm buying a tire here for $90. Oh, it's $100 over there. But tomorrow, the other one's going to be some different price. Like, it's so hard. This is what we talked about with inflation. It causes a lot of confusion in pricing, confusing in costs, up and down the chain. There's a lot of confusion. So as a consumer, it's really hard to track. And you've probably seen some of the stories of prices changing drastically. I just saw a video yesterday of somebody showing the gas prices changing almost instantly. It was up like 15%. So these things happen, and they're going to keep happening as long as we have these problems. But the profits eventually will start to slow. So what will happen is the economy will be confusing, but it'll start to get to a point where people are squeezed so much that they start to substitute for cheaper products. So instead of buying filet mignon, you're buying hamburger. Instead of buying hamburger, you're buying Spam, right? Instead of buying Spam, you're buying, you're out back shooting pigeons to eat, whatever it is. It's the point is as things become harder in the economy, people substitute for cheaper and cheaper goods. And what happens is the profit shrinks. So these companies have to shrink their profits in order to compete for that business. And every other company does the same thing. So their profits shrink. We've had enormously thick profits for so many companies in the last 13 years. I mean, the profits have been tremendous and has allowed these companies and stock price to go through the roof. But once the profits start to slow, all of a sudden, you're going to start to see it in the stock price as well. We haven't seen it yet. It's way in the future. You're talking many months down the road, and then of course unemployment is going to be last. So once you start to see the unemployment rate go down, all these other things have started to happen. So what are your thoughts on this chart, Doug?
Well, I just saw something at it came out yesterday or the day before that now 1 in 3 or 1 in 5 homes is starting to price their house lower in order to sell. So we've definitely started to see that happen. We're going to be watching those orders to see what happens there. I mean, there's some conflicting data that it's out there that we've talked about whether or not there is a slowdown in new orders that are coming through. Profits certainly are there, right? And that's the thing that's probably keeping the market up at this point, is that we keep getting more and more positive profit data. But I think this is a really critical chart to show you that if you wait until the profits decline, you may be so late into the economic decline that you are closer to it coming out than going even further, right? So a lot of times by the time that data starts to show, if you're not watching this really closely, you could react too late to the information and end up being late to the recovery, okay? So right now it's very important to be able to look at these things and start to see a pattern here, because by the time they do start doing those layoffs, we're in the worst part of the economy, and it's very difficult to turn around at that point and do something different. Going back to everything else we talked about in this show so far, this is exactly why you're concerned about these mortgages, right? Again, you take on this mortgage and let's say the home is underwater, right? Well, this is a reason, kind of like I said, I love no down payment on a mortgage, but that's only if you're saving an adequate amount outside so you have liquidity and flexibility. And let's face it, most people don't. They can't absorb it. The house is underwater. And then look what happens when the house is underwater and you don't have access to capital. Number one cause of financial stress is lack of access to capital, because then the housing goes down and you've lost your equity, number one source of wealth for most Americans. Then all of a sudden business profits start to decline and you get laid off. And what is your choices? What is your flexibility? It's another reason again, you know where I am on this, I'm a contrarian to it. I don't believe in extra payments on your home, because if you put those extra payments on your home, what are you going to do if you get laid off? You are only one payment away from that mortgage being in trouble. And until that payment is completely gone, you still have the same risk. So that liquidity of having access, if you're not sufficiently liquid, that's going to still cause you problems, even if you've been throwing double payments on every month. And I love how you talked about why not rent. Listen, renting, mortgage, it's the same thing. You're just paying someone for a place to sleep. That's what this is about, right? And now you go into, you go into this economy unprepared. You don't have the flexibility and the liquidity, and it creeps up, and there's going to be some major problems. And this is where we're starting to see a crack. I do want to say one thing though about inflation, Kirk. If you do have to go out shoot pigeons, just put it on the menu and call it squab, and you can charge a premium.
My youngest son calls them city chickens.
Yeah, well, the French call it fine dining.
Yeah, yeah, and he calls the seagulls sea chickens. So it's kind of funny, but I only make that point, and no one else will get the humor. But I saw this video a while back of people like how to, it was like for like homeless people, like how you catch pigeons. And I thought it was hilarious. Like they were showing all these techniques they use to catch pigeons to eat. Anyway, I'm just disgusting everybody in the show. I want to talk about one topic before we cut it off, and it was kind of tied to the college, but it's basically a trend that we're going to see at some point, which is debt forgiveness. So we started to see in the last few weeks when Biden started to claim, oh, we're going to do debt forgiveness for college, which quite frankly, I think is just a political maneuver to get for the midterm elections, conveniently timed. I'm not sure it's going to really go through, but I think a lot of people are optimistic about it, but I think practically it might be hard to do. And here's the problem. Debt forgiveness is one of three ways you can handle inflation. So, when you have, or I should say inflation, but money creation. So, the government has been creating money for a while, which eventually, in a sense, creates inflation. And so trying to inflate away, debt is one way that our government can handle that debt, right? So you have too much debt. Oh, well, let's just inflate it away by printing money. That's one way that governments do that. Another way that people handle debt is default. You could default on the debt, right? So in the case of college, you could default on your college debt, but it doesn't go away if you go into bankruptcy. So you're pretty much SOL when it comes to dealing with that debt. So you can't really default on it. The third way is a revaluation of the monetary system. This is like a last resort. It's something that's happened many times in history, but it's the last resort. So the first thing you're going to do is try to inflate away the debt. Second is default. And the third is revaluing it. Now, I mention these and I mention this order because while we're not there yet, I do see that if we continue down this path, we will eventually get there. And you should just know about that list because you don't want to be surprised when you wake up, be like, oh, all my assets are worth 50% less, right? You look back in the early 1900s when they basically confiscated gold. Now, I know gold bugs think that's going to happen again. I don't, because our monetary system is not tied to gold. So them doing that is kind of a useless endeavor. Not saying they wouldn't do it, but it doesn't have any value to them. So there's no point in them doing it. But back then they did. They took everybody's gold and then they priced gold a lot higher. Said, oh, thanks for the gold. Now we're going to price it at a higher price. So they just devalued your assets right there. And I can see this in history. If you go back far enough, they used to call this a debt jubilee. So what they used to do is every certain period of time, way back in history, hundreds or thousands of years ago, they used to go back and they would basically say, all right, all this debt is forgiven. No debt exists anymore. We're going to start from scratch. That was their way of handling it, was a debt jubilee. And we've done it in our own history. We just don't talk about it, right? We don't want to advertise the fact that we're doing this, but I think there's one of those ahead of us. And the problem is if you own a lot of debt, then it's going to cause a lot of problems for any people who own the debt. And I don't think it's a good idea either, because here's the point I wanted to make. College loans, right? So you take out a loan, Doug, you work with a lot of people who do this. You take out a loan, let's say you're taking out a loan for $50,000 a year. So at the end of your college, assuming you're 4 years, which I know is not as common anymore, but let's say it's 4 years, you owe $200,000. Now you owe that back. Okay. So what happened is in order for you to go to that college, you had to get a loan, which means someone else had to pay for your college. They paid the college. The college still got paid. They got paid their $50,000 a year from someone else. And now you owe that someone else $50,000 each year. Now, at the end, that person's already paid for your college and you owe that other person. So basically, at this point, you've gotten free college, which somebody else paid for. Now, at some level, let's say they forgive college loans, that means that that other person loses all of their asset. That debt is an asset, right? It's like owning a mortgage. If you're paying the mortgage, it's a debt. If you're funding the mortgage, it's an asset, right? There's two sides of the balance sheet. So if you are lending money to college students, then you lend them $50,000, you expect to be paid back plus interest. That's why you lent the money, right? That's the whole point. That's how our financial system works. So if they forgive that money, who's going to pay that other person? Is the government going to pay it? Or are they just saying, oh, you have to write it off? If you have to write it off, that person just lost a ton of money. Somebody lost it, right? If the government's going to pay it, okay, then the other person didn't lose it, but that means all of us lose it. It means all of us have paid for that person's college collectively. Now we have to decide as a society if we think that's right. But frankly, if you're taking out money for a loan, then you need to expect to pay it back, or you shouldn't have taken out that loan. And I know it's expectations of a 18-year-old student to figure that out is, beyond the scope of what's reasonable. But I think these are serious questions people need to ask. It's not a question of, oh, going to forgive loans, because then where does that stop? Hey, why don't you forgive my mortgage? Hey, I have to pay this house. Why should I have to pay this house back? And it goes down the line until every debt, people decide, hey, I don't want to pay it back. And then the problem is you just stop lending money. Why would I lend you money if it's going to go to zero, if you're going to get it forgiven? So I'm not going to loan money, which means you can't have loans anymore, which means you can't afford it. You can't do it. So everyone with the assets, they can do whatever they want. And the people who don't have assets, they can't do anything. That's where it leads, if you go down this road far enough, to a more divergent economy where you have the haves and the have-nots, and there is no middle, because the loans, the lending, allow the middle to exist. The only other solution is asset prices drop and plummet across the board, and they go down 90% and they stay there. So nobody wins in any of these scenarios. I'm not bringing this up to depress everybody. I'm just laying out the framework for the unintended consequences of actions like this. And I'm not saying it's right or wrong. I'm just saying this is what happens, and this is what it leads to if you go down this road. And I do think we're going down this road. It may not happen tomorrow, it may happen 10 years from now, but it is going to happen. So you have to recognize that policies like this, and we talked about this in the show before, that stupid political policies, they always happen. In the 70s, they happen. They're going to happen again, not because people didn't learn from their mistakes, but because Joe and Susie Lunchbox are crying about not being able to pay for their kids' college. And here comes, Super Joe come to the rescue and saying, we're going to forgive your loans. It's what happens every single political cycle. It happens about every, 20 to 40 years. It's going to happen again. So I just mentioned this as an education, so you're aware of what's happening. So when they do happen, you're not thinking, oh, that's a good idea, let's just forgive more debt. No, here's what it leads to. If you're willing, if you don't have any assets and you're just listening to the show because you want to be educated, great. It probably won't affect you. It will, but probably not in the same way. But if you're somebody who has assets, who has retirement savings, who's saved up and been very diligent, then this stuff should make you mad, because it's going to affect you. And your assets are going to be devalued, and you have to protect yourself, which is why we're here, is to help educate you on how to manage your risk, how to protect yourself. And this requires you to think way ahead of what you're hearing on the news. They're not talking about this. They're talking about, like, oh, here's what happened today. They're not talking about here's what's going to happen 5 years from now. That's what we're for. That's why you're here. So I know I went on a rant there, Doug, but any final thoughts from you before we wrap it up?
Yeah, well, first of all, I want to go back to what we said, since you touched on the debt again. About being taxable or or non-profit for these colleges. This has actually been an argument for the NCAA for a long time, right? It's a nonprofit entity running sports that was raking in billions and billions of dollars, and it has been put out there multiple times as to how the NCAA continues to have nonprofit status. But the Big Ten Conference just signed a $7 billion TV rights contract. That's a ridiculous number of like $40 million a year for every school out there. If I've got that right. No, it's like 70 million. I'm a math off right now. I apologize. The key is these schools are going to be getting an astronomical amount of money from this new TV rights. At this point, there needs to be some reconciliation around how much of that money is going to actually go for the benefit of tuition, and why are they not using it in means to lower tuition prices? Because they're not there. Now, you mentioned there are a lot of schools that are financially teetering. 98% of schools out there, they're worried about hitting quota every year, okay? The top 2% don't worry about that, all right? And but a lot of those other schools, they actually give a lot of discounts, a lot of scholarships and money to get people there. You don't pay the full tuition price, but people go to those brand name schools, they put their name out there, they market, they play a game that you are losing at, and ultimately get people hooked in. Going to the student loan side of things, there's 5 ways to pay for college, okay? It's private loans, public loans, cash flow, using your assets, and then using home equity in some capacity. Listen, if Joe Biden and the politicians out there are looking to get rid of those loans for you, that's only going to be on the public loans. The private loans are absolutely impossible to get rid of, even upon death or bankruptcy. Kirk, we already have a system for getting rid of debt. It's bankruptcy. We've always had that system. And what protects that system from everybody defaulting is the impact it has on your future. If you go through the expensive process of bankruptcy, you lose your credit, you lose your trustworthiness, and your reputation for the future is ruined. So people avoid it as much as they can. The school loan industry cannot be expunged through bankruptcy. Why? Why was this set up so differently? Because so if you go and you just get rid of $10,000 or $100,000 in loans, and you don't put people through a process of those that really need it, going through that process to get it through normal bankruptcy, then you just do it to everybody. That's when all of a sudden there's no accountability anymore. Okay. And it has to be paid, somewhere. So the government did this. 10 years ago, they took over backing, more than 10 years ago, they took over backing student loans to now providing them directly, and changed all the rules about it. And the last thing, again, about the politicians getting involved in great ideas and great plans, Barney Frank was behind those that wanted to make home mortgages more accessible to everybody. Then the economy collapsed. The housing economy collapsed in the mid-2000s. And guess who was one of the first people on front trying to put in regulation to solve the problem of these egregious banks lending? The same people that came up with the original idea. Now, again, this wasn't supposed to be politically sided. It's happened on both sides of the aisle. But these good ideas that they propose, 10 years later, they're the ones beating the pulpit saying it was a mistake and blaming somebody else. And that's just how politics works, unfortunately. So That's my thoughts. And I know it's been I just want to say thank you for having me, Kirk. If you want to find out more about myself, Douglas Heagren, ProCollege Planners, ProCollegePlanners.com. Go to our website, download our free money report on how much college is going to cost you and your family, where some discounts are, and then we can have a conversation on how to find money. And listen, if you think you make too much money to get a discount for school, that is one of the greatest myths. Find out how to get a full refund on the tuition that you have to pay for school. There are strategies to do that. Happy to talk to you. Find out more at our website. Thank you.
Great. Thanks again for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.